Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and this is Trading Places Live. It's Tuesday, November 15th, 2022, and I'm pre-recording this Trading Places Live for a bit later this morning. Currently, we see that futures are up very nicely. We got the Dow futures up 205 points, S&P 500 futures up 40, NASDAQ futures up 182. So on a percentage basis, NASDAQ futures definitely showing some leadership. That's about 1.5%. Crude oil futures are down a little less than $1, currently about $85 a barrel, and the 10-year Treasury yield down 5 basis points back to 3.81%. Let's go ahead and go through the agenda for today. Going to start off with the daily market recap, jump into talking technically, industry focus, predefined scans, earnings spotlight, and we'll wrap up the show with the three you must see. I do want to take everyone over to Earnings Beats. Couple of things to talk about here. First, definitely check out the no-cost trial. We have a 30-day free trial. This is a great time to join our service to at least take a look at it because we have started our fall special, which will run for the next couple of weeks. You can check that out, but basically the longer you subscribe for, the more free time you'll get. Because this goes on for the next couple of weeks, if you start a free trial now, you'll be able to check out the service to see whether you like it, whether or not this is something you would enjoy, and then sign up for the best deal that we're going to offer all year. If you do make that decision in the first couple of weeks, you get the rest of your 30-day free trial, and anything you sign up for would just be added to it. So I want to make sure that that's clear. Also, if you just want to figure out a little bit more about Earnings Beats, how we approach the market, I would suggest signing up for our Earnings Beats Digest newsletter. All it takes a name, email address, hit the subscribe button. It's a 3 times a week newsletter that we publish on Mondays, Wednesdays, and Fridays. We try to get it out around 8:30 in the morning, about an hour before the market opens. Very quick read, 2 paragraphs and a chart. That's the way we try to keep it, so it's very quick before the market opens. We focus on a lot of things that are important to us: relative strength, earnings, of course, gaps, candlesticks, those types of things. But make sure you check that out. Again, just a name and an email address, no credit card required. You can unsubscribe at any time. The other thing I want to mention is this Thursday, we are going to have our portfolio draft, what I like to call our draft. And when you think about it, when you put together a portfolio, I mean, think about the NFL draft and how you pick, and then you have to wait until someone else, the other teams pick, the other 31 teams pick before you can pick again. In setting your portfolio, you can pick any stock you want. Nobody else is picking. Well, others are picking, but you can pick the same ones. You can put your all-star lineup together. And that's what we try to do when we put together these portfolios every 90 days. So it is time. It looks like we are going to outperform again this quarter with our model portfolio, which is, as I scroll down here, you'll see we've had a tremendous amount of success since the fourth quarter of 2018. We've been through 3 cyclical bear markets: 2018, the trade war, 2020, pandemic, and now in 2022. We've been through 3 cyclical bear markets in the 4 years that we've been doing this, and we're up 115%, which is almost 2.5 times what the S&P 500 has done. So if you want to check out how we do that, I mean, we incorporate themes, what's going on in the market, what we think is going to happen over the course of the next 90 days. We take fundamentals into account. We take historical tendencies into account. And of course, we take technical, what's going on technically in the market. We use a lot of relative strength analysis to put those portfolios together. That's on Thursday. It is a member-only event, so make sure you start your trial if you're not already a member. All right, moving on. The recap, daily market recap from Monday. We had the Dow Jones Industrial Average down 211 points, S&P 500 down 35, NASDAQ down 127. So on a percentage basis, saw a little bit more selling on the NASDAQ yesterday. Mid caps down 1%, small caps down just a little bit more than that. All the major indices, though, now are up above. There were 2 key moving averages: the 20-day EMA, 50-day SMA. I'm asked sometimes why I use one EMA, one SMA. Mostly because the EMA when you're using an exponential moving average, it focuses more on the most recent data. I think short-term moving averages are more designed for that. I don't understand the logic between taking a 50 or 200-day moving average and then putting an EMA on it where you're focusing on the more recent data. The whole idea is to get a long-term moving average. I don't really understand the whole exponential moving average thing. But that's just my personal opinion. People do everything. I've seen EMAs and EMAs. I've seen SMAs and SMAs. I've seen a mixture. I like to use the mixture. Short-term EMA, longer-term SMA. That's the reason. Looking at the individual sectors yesterday, healthcare was the only group that was positive. So only 1 out of 11 sectors were up yesterday. And that was healthcare. Healthcare up near that recent high, near the 135 level, actually closing yesterday 133 and change. Energy lost just 0.03%. So, but it was up over 95 intraday and then came back down. It looks like maybe a little bit of a negative divergence beginning to form there. Higher prices, PPO rolling over. So maybe energy you might want to be a little careful with in the near term. Real estate just breaking back out above its 50, taking out 37.5, pulling back basically to test that level. I think that looks fine. Discretionary, we need a breakout. This is one of the weaker groups still. We were down 1.6% yesterday. We failed at the 50-day moving average. We had a lower low, higher PPO. What do we look for? 50-day test. PPO center line reset. One of or both of those. That's what I look for when I see a positive divergence. We got the 50-day test. We could simply just roll over and move back down again. I mean, the PPO is still negative. I don't think that's what's going to happen, but you have to respect that. A breakout above the 50 at this point would begin to signal something else. And that's why I would like to see the XLY do a little bit more strengthening here. Financials, very strong, got up near the recent high that we saw back in mid-August, right around that $36 level. It seems to be backing back off. That's what I would have expected. I think the next rally, maybe today, I think it's going to be more geared toward technology and hopefully discretionary stocks. We'll see what happens when we open today and how we trade. The 10-year Treasury yield, today we are going to get another inflation report. I don't think this one is as important, but it is still important. The October PPI, that's the producer price index, and that is expected to come in at an increase of 0.5% again for the month of October. September rose 0.4% on the headline number. So we're looking for a little bit hotter number. October core PPI, so we strip out food and energy, that's expected to rise 0.4%. September was 0.3%. So again, we're looking for a slight increase there. And then we'll have the November Empire State Manufacturing Index. October was minus 9.1. We're expecting November to be a little bit better at minus 7.6. Looking at the 10-year Treasury yield, here was a negative divergence. Just talked about a positive divergence on the consumer discretionary group and how we look for a 50-day test. Well, here's the flip side. You're moving up in the yield. We show a lower PPO, so we're showing slowing momentum in the yield to the upside. And what do we get? A 50-day test. We come back down. Now, does this mean that we're going to go lower forever and ever? No, it does not mean that. It could mean that that's the top. I mean, divergences can mark significant tops and significant bottoms. But again, what I look for is a reset. Once we get that PPO centerline test and or 50-day test, as far as I'm concerned, it's a new ball game. I look at it like, a 3-game baseball series where a team is up, winning the first game 10-0. You don't go into game 2 starting 10-0. What happens? That momentum from the first day, it's gone. You start back over again on the second day at 0-0. Who's going to win? I don't know. Same thing with these divergences. Once you get back down, you reset the PPO back near the center line. I don't know where it's going to go from here. I have my own opinions where I think it's going to go. I think rates are going to come down, but I'm going to look for further technical confirmation. And for me, that would be failure at the 20-day and then a new low. Now, it doesn't mean you have to go to the 20-day. A new low would work. Just going back down below the 50-day would start to make it look like we are rolling over. So that would be what I would be looking for here on the 10-year Treasury yield. Keep in mind that it was the breakout of the 10-year Treasury yield at the beginning of the year above 1.75% and the subsequent rapid rise in the 10-year Treasury yield that, I mean, that was one of the big reasons why the stock market was hit as hard as it was, and why many of the growth oriented areas underperformed so badly. It was the rising rates. So I think it just stands to reason that if we break back down to the downside, we are looking at potentially a, perhaps an explosion back to the upside on growth stocks. We saw that last Thursday and Friday. Personally, I think it's just beginning, but this would be the confirmation I'd be looking for. I want to see the 10-year Treasury yield trending lower. We go back up to 430, 435 and break out again on the 10-year Treasury yield, all bets are off. Let's reevaluate the market. But if we do break down below the 50 and we begin to trend to the downside, I think that would be a great indicator for the NASDAQ and many of the growth-oriented areas, the semiconductors, the software group, the internet stocks, many of the areas of technology, consumer discretionary, and communication services. All right, let's move on to the S&P 500 and talk technically here for a couple minutes. S&P 500 broke through that 3,900 level. That's what I wanted to see initially. You can't get back up to an all-time high without first getting through 3,900. And I believe we are going back up to all-time highs. I said it back here when I called the bear market. I said we were going to go through a bear market. We could potentially go to 3,500, 3,800, and then rates would come back down and we'd go right back up to all-time highs. I'm not changing a thing. I think that's exactly what's happening, and I think we're beginning that move to the upside. What would make me reconsider? Well, first, the rising 20-day moving average and gap support from last Thursday. That was new news. We had the October CPI report come out, came in much better than expected. The market reacted. All that money went toward growth. That is going to be a key gap support level, along with the rising 20-day. If you lose both of those, we reevaluate. If you don't, you play this as though we are resuming the secular bull market. That's the way I'm playing it. NASDAQ 100, same deal, breaking back up above the 50 and the 20. You can see the 20 is still sitting below the 50. If we go back to the S&P 500, we've gotten that golden cross. This is the configuration I look for in a bullish advance. PPO's positive, price actions above the 20-day. The 20 days cross back up above the 50. Price above the 20, which is above the 50. PPO positive. Long as we continue looking like that, I don't have any bearish thoughts. NASDAQ 100, same deal, breaking back up above. Still got to get that cross to the downside, watch gap support, and watch that rising 20-day moving average. And watch the relationship from the NASDAQ versus the S&P. If the NASDAQ underperforms and breaks back down below those moving averages, that combination would not be good. Does it mean we'd go all the way back down to new lows? I don't know. We might consolidate for a while. We certainly would open the door to retesting that 10,500 level on the NASDAQ 100. Again, I don't think we're going back down there. I think this is going to start an uptrend, but you have to be objective, try to remain objective, and look at both sides. A break below the moving average and gap support is where I would draw the line and say, okay, we need to reconsider, reevaluate. All right, let's move on to industry focus. So in industry focus here, what I want to talk about today is the home construction group. So on StockCharts, you'll find that with the $ DJUSHB. It's actually the Dow Jones U.S. Home Construction Index. Big move up last Thursday and Friday. We saw some profit taking yesterday here. Look at the area, 1,300. I mean, this is a big level of resistance. If we clear it, we will be at the highest level we've been in since March on home construction. Think about that for a minute and what rates have done. And home builders would be moving at that point to an 8-month high. That doesn't seem right. Not with rates up the way they are. I mean, mortgage rates now are 7% or so. Actually, probably back down below that. They were up over 7% last week before we had the CPI report come out and the big drop in the 10-year Treasury yield. But anyway, I mean, mortgage rates are much higher than they were. So why are we sitting here on the verge of potentially moving to an 8-month high on this group? Why? Because the stock market looks ahead. This is one of the reasons why I believe rates are coming back down. Why would Wall Street be moving back into home construction? Look at the relative strength. Home construction bottomed versus the S&P 500 back in April. Think about this for a second. 10-year Treasury yield. Where were we back in April? Beginning of April. Let me go back over here for a second to this chart. So yeah, that was the second week of April. So we come over here to the second week of April, right in here, we were at 2.75 on the 10-year Treasury yield. Since then, we have gone up to 4.33%. And the 10-year Treasury yield is really a barometer for mortgage rates. So we've seen the 10-year Treasury yield moving up. And if you look for homes or you've looked to, for a mortgage, you know what rates have done. Rates have continued to go up. So I ask you this question. Why have the home construction group, why has the home construction group moved up way off of that April relative low versus the S&P 500 and sitting at about a 10-month high or a 9-month relative high? Why would Wall Street be repositioning and rotating into home construction in the middle of what we have seen this year? Think about it. What's the rationale? And we're going into the winter months. Doesn't make a whole lot of sense unless you realize that the stock market looks ahead and the stock market sees the Fed pivoting and actually lowering rates going forward. We're going to see that 10-year Treasury yield coming down. And by the time folks realize the rates are coming down and they want to jump into home construction stocks, a lot of the moves going to be made. I think home construction is going to break out above this relative resistance area. We'll see. It's going to take, obviously, we're going to have to get through 1,300 to do it. But I want to also point out seasonality. And I wrote about this, by the way, in my Trading Places blog. If you go over to, Trading Places, go to articles, and then under all the StockCharts blogs, go to Trading Places, and then come down 2 articles ago. I think it was right in here that I talked about it. No, maybe I didn't. Maybe it was in the daily. I write so many things. But anyway, if you do go over to Trading Places, you can always go down to the bottom and you can subscribe. That's a free subscription. Any articles I write will automatically be sent to you. That's all they do. This is StockCharts getting your email address so that when I publish an article, it automatically gets sent to you. And this isn't just for me. This is for any of the authors at StockCharts. So if you have favorite authors over there, scroll down beneath their articles and make sure you type in your email address. I think that's a pretty cool tool, so that you don't have to keep looking for your articles to come when you don't know when they're going to come out. And so as a result, that's a great way to stay in touch with anyone you enjoy following. Anyway, back to the home construction group. I don't know where I wrote that article. Maybe I wrote it in the daily market report to members. I tell you, I write so many things. Hard to keep track of them all. But anyway, if you look at home construction, I went back 20 years, last 20 years, and looked across here. This is the average return for each calendar month over the last 20 years. I want you to look at November, December, and January. Just focus on those 3. First of all, the odds of home construction going up in any particular month is shown at the top here. That's 80% of Novembers over the last 20 years have moved higher for home builders. 63% of Decembers and 70% of Januaries. If you notice, those are the 3 highest percentages of the year. If you look at the performance, monthly average performance, November, December, and January, that's 9.5%. Average return over the last 20 years if you were just in the index November through January. I'd say that this is a seasonally strong period, which, when you think about it from a common sense perspective, makes absolutely no sense, doesn't it? I mean, it makes no sense. November, December, January. Home construction, I mean, when you think about it, you're thinking maybe March, April, May, springtime. Stock market looks ahead. Stock market's getting in before we ever see what's taking place in home building in the spring. It's already forecasting or it does generally forecast that things are picking up. We're seeing it again. We're seeing it with that relative strength I showed you. We're seeing it. We'll see it if we get a breakout on the home construction index above 1,300. When we talk about constructing portfolios like I'm going to be doing on Thursday, these are the types of things we like to take into account. I mean, you might think, wow, rates are up, you know, the Fed's hawkish. Last thing you'd probably think of is home builders. Well, I can tell you home builders are pretty high up on my list right now. I don't know if we'll add them. We'll be looking at individual stocks, but that's, you know, something to at least have knowledge of when you're putting together your portfolio. One other thing I wanted to show you. So, you know, you're looking at the home construction index. You're like, well, I don't know what that means. I don't know. How do I trade the home construction index? Well, you can't trade the home construction index. There are some ETFs you can trade, but I'm going to focus on how you can scan that index. So first of all, just get rid of all the default stuff there and come down to sectors and industries and go down under cyclicals and look for home construction right here. Click on that, add it. Now, when we run this scan, all we're going to do is scan for stocks that are in home construction. Run the scan, and there you have 21 stocks in home construction. Now, what I would probably do is look for ones that are liquid, maybe mid caps, large caps that are liquid. So maybe start with the top here. You've got Pulte, DR Horton, KB Home, Lennar, Toll Brothers. You can look at the scooters. Quick identification looks like based on scooters, DR Horton, Lennar are the two highest. Might be interested in those. Maybe if you're thinking small home builders, you know, here's small 746, but that's Beazer, but it's only 37 scooter. LGI Homes though, 59, almost 60. Oh, that's the other. That's just different class of Lennar. Hovnanian, right around 60. You can see though it's a $44 stock, but only traded 89,000 shares yesterday. So probably wouldn't be interested now. I'd be concentrating up in here. If I go and look at DR Horton or Lennar and they happen to fit some other criteria, they could be in our portfolios based on that relative strength that they're showing there. So anyway, that's how I would be going through the entire industry. So that was a nice little industry focus on the home construction group. Next thing I want to point out are predefined scans. So I just showed you a scan that we ran, just an easy one, but there are predefined scans over at StockCharts. So if you go to the scanning area, and if this doesn't show up on your dashboard, then you need to go right here to this gear shift and click on it and make sure that scans and alerts are checked. If they're not, then you're not going to see it. So make sure that's checked, save preferences, and then exit, and you should see this show up. Here, under this more little button, if you click on that, you'll get predefined scans. There's a lot of different ways to get to predefined scans, but that's one quick way. That's the way I usually go in. And then these are all predefined scans that the scan engine has already run for you. So you can take a look at what is important to you. You've got bullish indicators, you've got bearish indicators, you've got candlestick patterns. If you're somebody who really enjoys the candlesticks, if you're a point and figure technician, you've got P&F patterns that are already run. This is a lot of work that's already done for you in the predefined scans. So make sure you check out predefined scans, find something that works for you, and hopefully that will help you or help improve your trading. All right, earnings spotlight. So let's look at Walmart, which reported this morning. And wow, Walmart up $10, up 7.5%, 148, taking out these prior highs. Good start to the day for Walmart. I wrote an article about Walmart versus Target. I thought Walmart was looking better than Target. Target will be out tomorrow. We'll see what happens there. But we did get a nice move here. And another one that I talked about, which I thought looked even better than Walmart and Target, was TJX companies. TJX is a symbol. So if we pull up TJX, you can see this is one that's been trending higher. It's actually near a 52-week high. If you look at Walmart or Target, Walmart, there's the 52-week high back in April. You can see even with today's gap up, probably have another 10% to go to get to that high. And Target, if you look at Target after the big gap down back in May, I mean, it really has struggled to recover. That's why I think Walmart was the better play going into earnings, and we did get a nice pop on Walmart. And we'll see what happens with Target tomorrow morning. I'm pretty sure that's tomorrow morning. Let's see, what else did we have with earnings? Let me check this out. Home Depot. Let's look at Home Depot. So we've got, and when you want pre-market action, just click on this symbol summary in the drop down, and then just pull up whatever chart you're looking for. But there's Home Depot, actually down 1.5%, down almost $5 to 302. Aramark, that's a in the restaurant area, I believe. But that one's breaking out, up 2.6% today. Let's pull up that chart. Yeah, it is in the restaurant group. This is a stock that looks decent versus the restaurants. By the way, if you go down here to the restaurants, look at the restaurants. Restaurants have been trending up versus the S&P 500 since March. So when you look at it here, you might say, well, yeah, it looks pretty good. If you look at it relative to the S&P 500, it looks really good. And look at the volume that's coming into Aramark heading into that earnings report. And it closed at a 52-week high yesterday, just before this earnings report came in. Now, sometimes what you'll see is a buy on rumor, and then you'll get the gap up, and then you'll get the sell on news. So I don't know that personally, for me, I wouldn't chase. I don't like chasing gap ups, just because most gaps fail. When they don't, that's actually a really bullish sign. If the stock gaps up and just keeps going higher, I'd have it on my radar for the first pullback when it does eventually pull back. Okay, let's wrap this thing up with the 3 you must see. I'll start with Etsy. I love what's going on here with Etsy. If you look at the consumer, specialized consumer services group, it has been on a run here over the last 4 or 5 weeks. If you look on a relative basis, it's setting new 52-week highs. So we're starting here already with a good group. Now, Etsy, relative to the group, and like so many online companies, really have struggled in 2022, but we're starting to see that move to the upside. And if we could get that break above where we were in early October in terms of relative strength versus its peers, that would put it up at a level that we haven't seen since the beginning of April. This is one of those high growth stocks that you need to be aware of if interest rates come down. They are a rapid grower of earnings. And when you have a rapid grower of earnings and interest rates take off, you have valuations that crater. And that is what happened to many of these growth stocks. If rates come back down, and I'm seeing a lot of signs pointing to it, you'll want to be invested in some of these companies like Etsy, just pointing it out. Next up, let's see, Netflix. Netflix tried to make a big breakout yesterday, failed, but we might see it today. A break above 300 on a closing basis, and I think Netflix is going to 350 to test gap resistance. I think Netflix is looking much, much better. Internet's not so much, starting to maybe turn up a little bit, but look at the relative strength all of a sudden building in Netflix. So I think Netflix looks pretty good, and I wouldn't be surprised to see 350 coming. Last one, SYF. This is a company that actually had a nice pullback yesterday, but the AD line looks great. Here we had a break all the way up to this high in April, got very close to this resistance area. Now pulling back, I think anything down around 36, 37 starts to look very interesting near that 20-day moving average. All right, that's it for me. I appreciate you tuning in today. I'll be back tomorrow over at over at Earnings Beats for the next Trading Places Live. So if you do go over to Earnings Beats, all you do is at 8:45 Eastern, between 8:45 and 9, come on over, click on the Trading Places Live, and there will be a link. Right now, there's a link to the recording. But when on Mondays and Wednesdays, we have live shows, there will be a link here where you can come right in. You don't have to be a member. We'd love to have you. Anyhow, have a great day, everybody. Take care. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.